Good afternoon, this is Sean Golding with Golding & Golding, here to continue our 2024 series for filing your 2023 tax return for Form 8938. It's one of the International Information Reporting Forms. We'll talk about the due date, the filing requirements, the deadline, penalties, and what you could do to try to avoid or make the IRS go away when it comes to penalties. So Form 89, and one more thing, these presentations are geared toward individuals, U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test, individuals who have to file Form 1040. So the 8938 came about in conjunction with FATCA, the Foreign Account Tax Compliance Act. It was introduced in 2012 on the 2011 tax return, and it requires taxpayers who have to file Form 1040 to include certain types of foreign assets on their tax return. Depending on whether the taxpayer is single, married filing separate, or married filing joint, will impact the threshold requirements for having to file. If someone is if they're single or married filing separate and they're a U.S. resident, then they file it if there's more than $50,000 on the last day of the year, more than $75,000 on any other day of the year. If they are married filing joint and U.S. residents, you double that amount to more than $100,000 on the last day of the year, more than $150,000 on any other day of the year. For taxpayers who live overseas, it's a little more lenient. Single or married filing separate is more than $200,000 on the last day of the year, or more than $300,000 on any other day of the year. And if you're married filing joint and foreign residents, you double that amount to $400,000, $600,000. Various different types of foreign accounts and assets have to be included on the form: bank accounts, savings accounts, current accounts, checking accounts, investment accounts, securities accounts, pooled fund accounts, pension and retirement and life insurance that has a surrender value or a cash out. Now, depending on the type of asset you have will determine where on the form it goes. Unlike the FBAR, there are other questions it asks. While it's similar in terms of the account information or the asset information, the address of the institution and the maximum value, there's other questions they want to know as well. Was the account opened or closed in that year? Is it jointly held with a spouse? Were taxes, is there income related to the particular asset? So it gets a little more into detail than the FBAR. You only have to file Form 8938 if you have to file the 1040 tax return, but we'll get to that in a second. The due date for filing Form 8938 is the same as your tax return. So it's not on automatic extension like the FBAR. You file your tax return, it's due April or it's due June, depending if you live in the U.S. or you're overseas. If you file for the extension, the Form 8938 goes on extension as well. In other words, you don't have to file a separate form for Form 8938 like you have to do for other international forms such as 3520A. It's not required if the tax return is not required. So, for example, if you're a U.S. person, you have to file the FBAR even if you don't have to file a tax return when the threshold requirements are met. That's not the same for the 8938. If you don't have to file a tax return because maybe you don't have enough income to have to do so, but your assets would put you over the threshold for filing Form 8938, you generally do not have to file a Form 8938 that year. In other words, you don't have to file a tax return just to file the 8938 if you're above the 8938 threshold, if you don't otherwise have to file a tax return. It might be hard to get some of the information you need for the 8938. Some banks overseas are not easy to deal with. They make you come in person. That may not be a viable option. So you just do the best you could do with the information you have after doing a reasonable and diligent search. It doesn't mean do not file it if you don't have the information. That could lead you down a dark path of willfulness for a willful omission, reckless disregard, willful blindness sort of situation if you know you have to file, but you don't file. Nowhere does it say it has to be perfect. This isn't a test. It doesn't go on your permanent record, although it could go on your IRS record. But in all types of situations, your goal is to do the best that you can. If you learn that you should have filed it in a prior year and you have time before filing the current year return, we typically recommend to not do a quiet disclosure. In fact, we never recommend to do a quiet disclosure. When you get close to that deadline, you have to consider the options. Can you file an extension and what you should do? If you're in that situation, you should speak with a board-certified specialist. So what do you do if you haven't reported in prior years? Well, various things could happen. Sometimes nothing will happen. The IRS just hasn't pulled your card yet, which is great. You might get a soft letter, which is just a reminder like, hey, we have this information from your foreign financial institution. It says you have these 3 accounts. Your tax return doesn't reflect these 3 accounts. why don't you go back and fix it? Otherwise, you may receive an audit or examination notice or penalties by way of a CP-15. Depending on whether you're willful or non-willful in your prior year, non-compliance would determine different options that you have that we'll get to in a second. Forget the fear-mongering nonsense. The majority of the time you're going to be non-willful. Sometimes you're willful, and rarely, if ever, are you criminal. It does happen, but oftentimes it involves ancillary factors such as money laundering, structuring, smurfing, evasion, things like that. Not you have an account in Peru because that's where your grandma lives and you didn't know you had to file it. That's not criminal. If the IRS does come after you and they do get a judgment against you, they could put a lien on you, on your property, levy your accounts or your wages. They could seize property, although the latter one is pretty rare. They could do it in the U.S. and they can do it overseas as well. The United States has entered into more than 110 FATCA agreements. Hundreds of thousands of foreign financial institutions report to the U.S. government. There's other various agreements that the U.S. has to cooperate with foreign countries. So especially if in a country like Canada, just because your assets are there doesn't mean that the IRS can't get their grubby little hands on them. If you're out of compliance for prior years, there's various programs you can use to get into compliance. If you're willful, you would do the voluntary disclosure program. If you're non-willful, there's various other programs available to you. They're the streamlined procedures, delinquency procedures, and reasonable cause. We've got a ton of free information available on our main website and our sub-website. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.